Okay, on today's episode of the Investing City podcast, super excited to have George Krijgh on. So thanks so much for being here, George.
Nice to be here.
So I think it might be helpful to just start with a little bit of your background. How did you kind of get to the place where you are, and just tell us a little bit about your investing journey?
Okay. Yeah, as a kid, I was always impressed by Berkshire and their culture, and I thought, okay, it would be cool to do that as a professionally. But then I did a bachelor in physics, and then was so inspired in Berkeley actually by a professor called Alexander Filipenko, who was in the supernova team, and basically coming up with proof that we were living in an accelerating universe. Um, instead of a static one. So, but almost did a master in astrophysics, but then kind of my hobby that was investing just snowballed into more investors or people around me asking, "Hey, what are you doing with your money?" And so I ended up doing a master's in finance and then working in the equity research department of a bank. They offered me a job in 2007, just before the financial crisis, and made me like the research analyst on the banks and insurance companies. So from day one onwards, I had to explain CDO portfolios, etc., to institutional investors, and I did it for 2 years, and then things became quite cheap in 2008 and 9. We bought a lot of things at very interesting prices, and a few families that I was communicating with about investments. They said, "Hey, why don't you do this full time?" And I always wanted to do it, so I started my own kind of partnership or fund, the Guardian Fund, in 2010. And now, 11 years further down the road, we I personally went through such a transition as an investor, like such an evolution. I think back then we were super focused on maybe companies where much of the value was very measurable in the balance sheet or in the earnings statement. And today, I think the bulk of the value I perceive in a lot of companies is actually more to be found in the intangibles. I had a few really good friends from university who worked at the frontier of machine learning, for example, at DeepMind and OpenAI, and I spent time with them. And I think in the years 2014, 15, 16, they really kind of opened my eyes that to the scalability and the importance of machine learning and data analytics. And I kind of these were the years that more of the portfolio shifted away from, let's say, maybe consumer goods company towards the tech ecosystems. And yeah, now we like 11 years further. We are very focused on tech, so we're basically a tech investor. I don't think it's easy to say this is a tech sector. There's a clear chocolate sector or a beer sector, but it's tech is almost, even DHL and future banks. I think every winner in 2030 will have like superior software in the core. Otherwise, it's just hard to compete. But yeah, 5 years or 4 years ago, no, 5 years ago, we took a stake in a company like Shopify, and this was maybe an example of the first kind of investment we made in a company where we really respected management. It was completely clear to us that the TAM was the total addressable market was huge. We were just terrified. I was terrified by the valuation. I thought, oh wow, this is so speculative. Buying Shopify at $60 per share, and I started a really small position, hoping that the stock would go down, and now it kind of 15x, and it was a very important lesson that I think the great companies of our time, I think it's very hard to wait until they have a seemingly low valuation, because I don't think it will ever happen. So I think, and then I stopped talking, but I think one of the single biggest lessons I think one could learn from Berkshire is that once you buy something, a really good company, it's basically not available for sale. You just keep it. And then one of the great things you can learn from a company like Amazon is that in the at any point in the last 15 years, except maybe the last 12 or 24 months, Amazon was this great company that everybody knows is a winner, but very few people actually owned the stock for more than maybe a few years, because it was very hard to own that stock, because the Financial Times and the sell side and everybody was commenting how expensive the stock was and what a kind of a bubble this company would be, and valuation crazy. And then in the meantime, I think top tick to bottom tick, the stock went down more than 30%, I think at least 15 times or so in the last 15 years. So you had to go through all these I told you so moments where, you know, you had to own this super expensive stock, and then it went down so many times. So there's just few people who hold on to it, I think, and that's probably the reason why, especially so few institutional investors, they made a home run in the slipstream of Jeff Bezos. I think, having said that, that's kind of the maybe the between now and 2030. I think you have to be super comfortable owning great businesses, but at full valuation. And anyway,
Yeah,
that's the
super.
introduction. So we're long only tech oriented investor.
I love that. So I'm always curious with that evolution. You bought Shopify, say 5 years ago. What did the portfolio look like? Was it Shopify and then a bunch of consumer goods
Back then
companies
it
as
was
you?
so we our first kind of tech company we bought was Microsoft in 2012. Um, I was just so cheap, like trading at 8 times free cash flow, and the PC business went down a lot, but the enterprise business was clearly like becoming a bigger part of the company. And it was just, I mean, if we two, the both of us, would have been able to buy Microsoft back then and just put it in a runoff, you would have made money, right? So there was kind of an easy value investment, because you could just like put a multiple on free cash flows, right? And I think it became a little bit harder, like for a company like Shopify, where it was so much earlier in the S curve of the company, so much earlier in the life cycle, where like maybe similar to Amazon, there you had this company that was generating quite significant cash flows, but they had the luxury to reinvest it in the business at very attractive returns on invested capital. But a lot of that investment was expensed in the P&L, so you don't produce any US GAAP or IFRS earnings. So how was the portfolio back then? Yeah, so it was very kind of a weird mix between maybe, you know, what would people say that are traditional value investments, and then having these what people would call growth investments in the same portfolio. I don't really think you can make that distinction, but I think the market still does it today. But yeah, so we had to go through that transition. But I mean, at some point we had Berkshire in the portfolio, right? Just because it's screen cheap, and it was cheap. But um, now I think, you know, there's not really so much added value for me as an investor to own a company where the expected maybe CAGR could be around 9 or 10%. It's a great, amazing holding for a family office. It just, I don't think we should own it in the portfolio anymore, because I think, you know, there are companies you can own that have a much better expected return, risk adjusted return.
Hmm.
Yeah.
So on the valuation point, I think that that's something that prevents a lot of people, just, okay, it's optically very expensive,
Right.
never going to buy it. What has kind of given you, so you bought a small position in Shopify. What's kind of given you, like, what's been your North Star as you've held it for the past 5 years that says, okay, we're holding
Yeah.
this and there's no problem.
Okay. So the mistake we made with hindsight is we started with such a small position, right? That was the mistake with hindsight. The thing we did well, I think, is we never sold a share. We never sold it, and it just became this bigger part of the portfolio because it went up so much. And I think I have a temperament where if I buy something, I can truly put it in this not available for sale bucket, right? And I think, like, if we are convinced it's a triple A company, and I think Shopify is also still today. Today the multiple is way lower than the moat is bigger and the margins are better, etc. It's much more diversified. There's not really any competition anymore. But back then it was harder because it was much more like a venture kind of investment. But I think equity investors can learn a lot from the best venture investors like Bessemer or Altimeter or maybe Tiger or Sequoia, where you want to keep reinvesting in your winners, but then just keep owning them at full valuation. And I think it's cool to see the equity portfolio as maybe, you know, trying to get one or two fund performers. So really stakes that become such a big part are so successful that they have a real positive impact on the portfolio. And it's very hard, of course, because all public funds, they have some kind of, you know, constraints. It cannot be more than 50% of AUM or 20%. So that's the only disadvantage. But so maybe at that point you have to sell.
Gotcha. So yeah, I'm really interested. You mentioned Shopify, like you're able to put a company in a bucket that says, you know, shares are not available. How much research did it take you in the early days? And is it more of just like evolution? What's your process for scaling that up over time? Like what data points did you see where you're like, okay, I need to add to Shopify actually?
Yeah, so Shopify, I think, is a company where you saw um, amazing unit economics, right? Not just growth. And I think between 2012 and 2020, um, revenues grew from 24 million in 2012 to 4.7 billion, or close to 4.7 billion in 2020. And in order to achieve that revenue growth, the company had to invest like 50 million of EBIT, right? So it's just amazing how much power every dollar invested had, right? And so there are all these unit economics that are so interesting. Also, for example, in 2020, Shopify invested, I think it's 40% of gross profit to achieve in the next 12 months 80% growth, whereas maybe a similar company that would be active in a similar market, let's say Wix, I think they invested 60% of gross profit to get 20% growth in gross profit, right? So somehow something is going on where maybe business is much more inbound for Shopify, so they have to spend way less to acquire new clients versus maybe a Wix or another company. And so I think if you see very attractive growth compared to amazing unit economics, it's easier to model out how that company would look in a few years' time, and you get a better feeling how, if the multiple screens very high today, that maybe if growth is, let's say, around 100% or 80%, it almost halves in in 1 or 2 years, right? And this is today actually still the case. I mean, the share price came down quite a bit, right, from the peak. I think it's down, I don't know, at least 40% from the peak in October or so, or September. But we are still talking about a company that has this year maybe 6.8, maybe 7 billion of revenues, growing at a very attractive rate, and just such a long runway of growth ahead that is not very crazy to just think, you know, this is going to be a company by 2025, and certainly between 2025 and 2030 that has maybe between 30 billion and 50 billion in revenues, and then with very healthy margins as well. So I feel a company like that gives us as investors much more margin of safety, because it grows so much into its valuation really rapidly. Even if, let's say, we would have more multiple compression, if 10-year rates go up from 2% to 6%, right? It's not impossible. So let's say that happens, then maybe in that world, it's even more important to own certain companies that can just grow through that multiple compression very easily. So today, I think at current multiple for Shopify, okay, maybe there's a little bit more downside. That's possible, but if the business keeps just on growing like it does today, and people always think, you know, now is the moment that reverse to the mean is going to happen, and I mean, this is probably the single biggest reason why people underestimated Alphabet 5 or 8 years ago, right? Nobody thought that these companies would scale so much. And even if you saw the earnings of the big tech companies, like the big cloud companies in the last 2 weeks, it just for me, it's just amazing that companies with that big revenue base are still able to grow so much. And Shopify, everybody knows it, everybody talks about it, but it's really still this 7 billion revenue company, right? And even, I mean, Palantir or Databricks or Snowflake, they're big names, but if you look at the revenues, it's just so Mickey Mouse, even compared to, I don't know, even compared to Amazon's ad income, right? Which is a little bit less than 40 billion. Those companies are still so tiny. So if they're any good and if they stay relevant, then they're still so small compared to the opportunity they're addressing.
Yeah, really, really interesting. So is there anything, I mean, you've held Shopify all this time, haven't sold a single share. Is there anything that if you saw this where maybe the business started deteriorating, like what is the point where you would actually sell? I'm just curious. For those
Yeah,
AAA companies, there must be something that where you say,
yeah.
okay,
I
maybe
think
it's time to sell.
I think if it would just if growth would come down significantly, right? Growth will come down a little bit, maybe because of if the world reopens, etc. But I mean, it has to be higher than maybe 50% or 40%. I think that's one thing. I mean, for us, we like to be invested in companies where there's a founder at the helm, or where you have this entrepreneurial management a culture. And I think if we would see founders leave or sell or being very distracted, that would be a red flag to us. But in case of Shopify, of course, also for any company, it's competition, right? If we see really very significant or strong competitors coming in, and it's very hard in certain markets to judge competition. For example, in food delivery, it seems like a knife fight to me, and payments, it's super competitive as well. So these there are these sectors that are just naturally there are multiple players. Um, I think even in cloud, most companies, they don't want to be locked into either the Google Cloud or Azure or AWS. And I think this is the opportunity for maybe Snowflake, to have this kind of cloud neutral service layer on top of it. But in case of Shopify, I feel that since we owned it, the distance between the leader, Shopify, and maybe the number 2 or 3 or 4 in the market had actually increased. So I think the moat of Shopify compared to any other player has increased. So I feel it's that it would be very I would be very surprised if suddenly some company would come out of nowhere, financed by a lot of money from Silicon Valley investors or so, and then suddenly takes a lot of market share, because I think it becomes harder and harder to compete with it, because it's not a marketplace like maybe eBay, or it's really an operating system, right? So I think it has become this operating system. And uh, even Amazon, who has such an amazing advantage in fulfillment and their logistics network, etc. But probably like in the last 12 months or 18 months, large enterprises became a client of Shopify Plus, like Colgate Canada and Linton Sprungli and Kraft Heinz. And those companies, I think they use Shopify because they see it as their kind of operating platform, right? Instead of building their own tailor-made platform in-house with their own ITers. And I think a lot of these companies, they try to build that, and they failed a number of times, and it cost them a few hundred million. And now they open their eyes and get a bit more realistic and think, okay, our core business is, I don't know, to sell toothpaste or Coca-Cola or chocolate. It's not to run a cloud business, not to run a cybersecurity business, not to, we don't have an army of machine learning experts that can analyze all our data. So I think the company architectures are getting more modern, in the sense that you have this core business, and then around it you have this kind of network of APIs or specialists. And Shopify's can be Colgate's operating platform for commerce, but I don't think Amazon will be Nestle's operating system for software, right? For commerce. So back to your question, I think why are you able to hold on to a company? I think if you see the distance increasing between this company and any competition, uh, that is reducing the risk that somebody will just take their business away or compete their margins away, right? So, and also in the case of Shopify, you saw pretty stable take rate on the SaaS business and pretty stable kind of margins they take on the GMV, gross merchandise volume. So I feel um, now they have this position, and now that GMV volumes will just keep increasing, especially the digital ones, between probably in the next 10 years or so, that it's just that this business has kind of a royalty on GMV, right? Maybe in a sense that Coca-Cola is making a certain royalty on a certain percentage of non-alcoholic beverages that people drink. That's kind of a nice way to make money, to just have a little royalty stream on all of that liquids going down people's throats. And I think Shopify has a kind of a royalty stream on digital GMV volumes because they're so relevant, and these GMV volumes will just keep increasing. So then the question is, okay, what's the chance that they will lose that royalty stream, or that royalty kind of fee will halve or go down because of competition or because of clients are not willing to pay for it? But I mean, if you talk to Shopify clients, the value they think Shopify delivers to them is like a multiple of what the costs are. So it's like Bill Gates said at Microsoft, their target would be to deliver Microsoft clients 8 times or so valued compared to what they pay. That kind of gives it some kind of pricing power. I feel, right. You
Totally.
don't want to take away in terms of price equal to what you give to your clients. That's a very bad deal. I think that gives more margin for competitors to do better.
Yeah. So I think that that's a great insight. Just seeing the distance between the Shopify's and the second competitor, and if that's continuing to widen, the moat's continuing to widen, your risk is actually going down. So maybe even paying a higher valuation makes more sense.
Yes.
That's super
And
super good.
because they're not a one-trick pony, doing one specific feature or tool, and then suddenly there's this company you never heard of, and they do it twice as good or 10 times better. Then your business is really kind of very impacted very much. But I think if you want to be an investor more in the technology space, as we all know that there's so much disruption and there's so much innovation, and like free markets are so disruptive. How do you protect yourself as much as possible against the scenario that, of course, we cannot know everything, we cannot read everything, we don't see everything, but you don't want to own this kind of one-trick ponies that suddenly are not so relevant anymore, but and you paid this high multiple because you thought it was this great company. So I think if you focus on the enablers, the ecosystems, the operating platforms, where it's just very sticky, you reduce your risk there.
Hmm. Are there any companies other than Shopify that you see as those sticky ecosystems or platforms?
Yeah, I mean, very much. Well, I mean, we don't have shares in Autodesk, but we had in the past. But Revit is software for architects, and I think I don't know if you have friends who are architects, but if you talk to them, it's very difficult for them to do business without having Revit. And I think Autodesk, it was acquisition by Autodesk, but I think they kept investing in it and making sure it's super relevant. And now here in Holland, there's this bridge that was built by Revit, and there's machine learning that kind of came up with this very interesting organic structure that no architect or human would probably come up with, and it could be 3D printed. Or the Shanghai Tower in Shanghai, this weird shape was also was a conclusion of a simulation, like how we reduce the wind load on the building, and this kind of shape made sure the wind was kind of going, not hitting the building just like that. And I think it reduced building costs by 56 million, right? Just reducing the wind load. So there's these network effects. So I think the only churn for Revit would be like if if architects, if they give up their shop or they merge, right? Then something like that. So there's almost no churn, and then there's its pricing power of 6% per year or so. So this is a company like not in our portfolio, but some companies are interesting to think about like what they're pricing. For example, Spotify is in contrast to Shopify, where consensus is pretty bullish about the company, right? Spotify is this company that people love the product, but they don't really know how to think about it from an investment perspective, and as a result, it's not trading at 15 times revenues, but like 2 times revenues. But of course, it's logical it's only 2 times because like most of their earnings are paid out of royalties. But at the same time, they're growing engagement, they're growing subscribers, they're growing kind of their ability to monetize engagement by placing more relevant ads into podcasts and shifting away from the commodity streaming business to like, you know, maybe the future real client of Spotify would not be me as a subscriber, but you as a podcast host, you know, to give you the tools to either monetize your business in a certain way or accept ads and all. I mean, you know more about that than me because you're actually the creator in this conversation. But then if you look at how music or audio is monetized, right? I think it's like 10 cents per hour of entertainment, and it's so low compared to any other form of entertainment. So then the question is, if you have that very engaging audio platform, how can a business actually monetize it? I think that's a very interesting scenario, and we think this company will be able to do it, and you see like first signs that they can, because for example, the ARPU of the freemium user, you know, it increased to $1.7 last quarter, and it's up a lot. Although they're entering international markets where maybe the ARPU per freemium user is lower, so I think they're figuring out like, okay, how to monetize and how to increase the ad business for that company. But I think, you know, Shopify would be the AAA company here, where it's obvious you pay a higher multiple, and Spotify would maybe in my view would be like the single A quality company, where I have a lot of respect for Daniel Ek, etc. But they're still in their land grab phase, but they still haven't shown very healthy unit economics. They still haven't shown that they can really monetize the kind of the position they have built.
Yeah, that makes a lot of sense. So with the AAA versus single A, how do you think about position sizing with that? Like what's kind of the framework there?
Okay, the framework is that we have a certain maximum in our fund that we are not allowed to have more than, you know, like 30% in one stock. I think this makes sense for LPs to have some kind of protection. It doesn't necessarily make sense if you think from a venture kind of mindset, right? So Shopify has now become a big position because we never sold a stock, and I think this is also going to be kind of the way forward. We usually own between maybe 8 or 14 or so holdings. I think the holdings we have in our portfolio now, we see that they'll at least have the potential to 3x in the next like 4 years. So our job would be to be very focused on the operational performance of the business and just let the share price do its work, right? And not try to trim it all the time, which was my major mistake in the last 10 years. I kept selling great companies or chopping off, you know, positions, like trimming positions, because yes, it was a great company. Yes, I could see their runway and the unit economics were healthy. I was just so uncomfortable with the valuation, and I really believe that if valuation is your number one reason for selling a great company, that's probably a very bad decision.
Yeah. Is there at some point, I mean, I've had the same exact mistake many times. Is there some point where the valuation does get too much? Like at some point, It gets
Absolutely.
crazy.
Yeah, absolutely. I mean, okay, outside of tech, especially because if you deal with like a linearly growing business, right? Like, or there was Rivian, or you had these electric car companies that were not Tesla, and they were or SPACs trading at, I don't know, tens of billions of dollars, and it was basically just a bag of money with a big idea without like the execution, etc. Okay, then for sure. But if your question is more concerned about tech companies that are showing exponential growth, then it becomes more difficult, right? I mean, it was so interesting in the sell-off that actually some of the companies that entered the sell-off with the highest EV multiple, right, the EV to price, actually did quite well. And for example, Datadog or Snowflake or maybe Shopify as well. So the market was actually making a distinction, not just based on multiple, but also like the quality of the business, I feel. And I think it's interesting that the market saw it pretty well, right? Because Datadog came with figures, what was it, yesterday, and was
Yep.
amazing. And Snowflake is this company where it's just hard to imagine them not to 5x or 10x revenues between now and the next 6, 7 years. Because also cloud spending is, what's the figure? Is it quadrupling or so between now and the next 6 years or so? But it's like a huge growth in the market, and if you're relevant there, it's just hard not to grow, right? And
Totally.
so the valuation is, we we looked at a company like Cloudflare, and there you're talking about a company that will have like this year maybe 900 million to a billion in revenues, and it's trading, what is it, about approximately 40x, right, or 37,
Mhm.
which is maybe kind of the question, like, okay, why is it that high? Yes, it's active in cloud. It might become this big player in edge computing, or in computing at the edge and security, etc. And maybe the market again has it right that they put a company like Cloudflare at that multiple, but it's just, for us coming from this kind of value mindset, it's much easier to buy Shopify now, which is this clear operating system and very dominant, and very hard to see a second or third player, and at a way lower multiple, right? So
Mhm.
I think there are multiples that are just too high. I mean, on the other hand, what we investors in equities can learn from the best VCs, right, is that if you are a successful VC, the, 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 the your biggest source of margin of safety is probably the quality of the management team, right, and the execution. So
Yeah, exactly.
and just to invest in it, and not be too concerned, because if you deal with a company that has the potential to 10x or 20x, it doesn't really matter if you pay 50% more or less now, strangely.
Totally. If you can see that 20 and 10x, then it is true. Quibbling over, 10, 20% is actually not that much in the kind of grand scheme of things. So I love that you mentioned Snowflake, and you mentioned Databricks earlier. So you guys are doing some private investing now, right?
Yeah, so we have the flagship fund, that's the Guardian Fund, and it's only an investor in public markets. But 3 years ago, I wanted to invest some private money in pre-IPOs, and specifically in a company back then. I mean, we were able to apply a block of shares in Palantir at a very low valuation. I think around like $5.5 per share, and was a big discount to the previous funding round years earlier. And I had some friends at Palantir, and they were able to explain to me like what their niche competencies were, and like, that it's very hard for other companies to get that kind of level of trust working with certain government agencies, and how that niche could actually be quite a big market, right? Because enterprises have moved or are moving to the to the public cloud, But even there, I think Satya Nadella said that the CEO of Microsoft that 20% of workloads have moved. So there's so much legacy, but in enterprises. But imagine like government agencies, etc. Right? And then they just won't work with anybody. And I think it's a huge opportunity for Azure and for AWS and the Google Cloud, but also for smaller companies like Palantir. But back to the fund. So we have this. We launched the crossover fund 3 years ago, and now we also own a stake in Epic Games and in Databricks. Databricks is a company we heard so much about it already for years. Um, Maybe like many of your hosts or your guests, I mean, or investors. We have this Tigis subscription where you get access to these expert network calls, and you can just type, I don't know, Snowflake, and then you get all these transcripts where maybe clients who made a decision, like CTOs who made a decision whether to become a client, yes or no, of Snowflake or Datadog, and or Datadog versus Elastic or Splunk or those kind of companies. So it's very interesting, but also because often there they mention private companies that are not listed yet. And I think in the past we often read about Databricks, that they're also clients of Databricks, and they describe this product as insanely great. And if you just keep hearing about it, we thought, okay, let's start talking to people who work at Databricks. Maybe they're able to explain us better how that works. And we did our research, and we thought, okay, this is such an amazing company. Maybe the first machine learning as a platform company, where you have just not only the data warehouse, but also the whole analytics layer on top of it. Which, by the way, I think Snowflake also likes to build, but it's hard, and it's a huge market. And then we try to be own shares, but the company never when insiders wanted to sell, they did a buyback, so it was not possible for us to become shareholder. And then it worked out in last year, so we're super happy to have a stake in that company, and it's I think it's going to be a very interesting company. And we also think that we hope to be buyers in the public market, when they would start their public life. And so we don't buy the private later stage ventures companies just for the trade, but only if we think, okay, that could be a business that we are shareholders of many years in the future. And I think Databricks is interesting because it's such a big player in the cloud. Um, and I love that field. I mean, if I would be forced to pick one area where you can only invest there, then probably like the cloud players wouldn't be bad, because
Mm.
it's going to be. Have you read the book The Rise of the Data Cloud by Frank Slootman?
Yeah, I'm
Yeah,
a big
yeah,
Slootman is amazing.
yeah, it's nice, right? And I mean, somewhere there he writes that he thinks the migration to a public cloud is probably the biggest event in human history, in terms of how we interact with each other and how we organize ourselves. And I kind of see that it's not obvious to many people who just don't deal with it, but maybe they're users of apps and that they're organized in the cloud. But this is such a big event, such a big wave we are riding, and I think this wave will just be gigantic for the next maybe decade at least. So it's a very interesting hunting ground to invest. It's very hard as well because it's just so consuming to understand companies like Databricks or Snowflake or Cloudflare, and but yeah, I think it.
Definitely. So I'd like to hear you talk a little bit more about how you think about competition between Snowflake and Databricks.
Yeah, so they overlap a lot. Um, Databricks is built around like the open source philosophy, right? Um, I think that's a very powerful field to hunt for interesting investments. So whereas Apple or maybe Facebook would be more like a walled garden where they try to control what's happening within their garden. We see these companies that are more open source and they basically attracting this developer ecosystem and also enabling creators, developers, or people to do things. So great examples of the open source are, for example, Elastic, right, where you have Elasticsearch, which is open source, and but Elastic is this company that kind of built services on top of the open source platform, and then it's up to the companies, yes or no, to pay for those services. But they, if they're good enough, then a lot of companies they actually probably conclude, okay, we can work with the open free source ourselves, but that means we need 3 or 10 full-time IT people in house to do it, and that there's a certain cost associated with it, or we pay Elastic a certain sum, per year. So Elastic, but also Databricks. It's around Apache Spark and Confluent, and even Spotify would, in a way, you can perceive it as a kind of an open source platform because they don't try to directly monetize you as a creator, but they just want to have this platform and that everybody goes there and you can bring your audience there. And Spotify doesn't necessarily want to make money of it, but they just want to create engagement, and then they will figure out a way how to monetize it. And so the difference between Snowflake and Databricks, one of the differences is that Databricks is this open source kind of philosophy where the company is building products, and then often startups, they can use Databricks for free. But if you really want to skill up, you start, probably it's a good idea to start paying for Databricks. And at that moment, the net retention rate is very high because, like Snowflake has this, what is it, 180 or 186% net retention rate. So it just would continue growing without actually adding new clients because they just grow so much with their clients. And yeah, okay, so open source Databricks, more proprietary technology Snowflake. There are advantages and disadvantages for both, I think. Um, Also, Snowflake is, I think, a little bit more focused on getting your data, making it very easy for companies to migrate their data into their data lakes, right, and their data warehouses, and 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 Databricks is more offering the analytics as well, and the and the machine learning. But I think both companies will compete with each other. Both companies will probably, the whole cloud ecosystem is kind of interesting because even Snowflake is one of AWS biggest clients. So in a way, they're a very important client of Amazon, and on the other hand, they're also competing with Amazon.
Mm-hmm.
Seems to be we're entering this world where it's very hard for new players to build the infrastructure cloud, right? So if you and I would have 100 billion or so, maybe it's not enough money to actually start competing with the Google Cloud or Azure or Amazon, because they're already so far ahead building these very hyper efficient servers and chips and operating the infrastructure. And then on top of that, Databricks emerges, Snowflake emerges, Cloudflare is also building their own servers. And on top of that, the whole cloud native ecosystem kind of, you know, builds. And I think the mode of, because even Snowflake and Databricks would not, by not deciding not to go into the infrastructure and build that themselves, just actually grow on top of the infrastructure, it increases the mode of the players that have the infrastructure, because fewer and fewer people think it's a good idea to actually start competing with that. So it's like, okay, so the returns probably get more commoditized for those players. It's more like a commodity infrastructure base, but it's not that bad to be the commodity player in that market that's growing so much and everybody is kind of buying your compute and your capacity.
Yeah, that's super interesting to think about.
And also one last thing, I mean, like Databricks, like Snowflake, right? we hear about a lot about those companies. But what's the revenues of AWS? It was like 75 billion or so, right? So that's the biggest player in the cloud, and then Azure and the Google Cloud. But I mean, Databricks and Snowflake, they're around a billion of revenues. It's so tiny compared to how I would perceive, you know, how big they would be by just listening to how many companies are using them and thinking they're really great. And I think also, when Berkshire invested in Snowflake, they did so because Snowflake was solving problems for Geico. So
Mm.
Geico had these problems, and then uh, they heard that about Snowflake, and Snowflake was able to solve a lot of these issues. And they were so impressed that I think once Charlie said it was a mistake by Berkshire not to buy Google shares, because when they were using ads at Geico and paying for ads, they saw the return on those marketing dollars spent, and it was just a no-brainer to understand how powerful Google was, and it never led to an investment. And I think maybe compare in comparison, like Snowflake now, they were able to see how powerful the service or the product of Snowflake was, and I think it helped Geico so much. But what I want to say is, then okay, then you're talking about Berkshire, right? There's so many other companies uh, that are part of Berkshire that would also benefit a lot by becoming a client of Snowflake. So that's just one company that is growing a lot as a client. Um, so I think these multiples for those companies, they're probably justified.
I think when I was first looking at Snowflake, somebody described to me an interesting insight that AWS marketplace salespeople were actually getting paid more in commission by selling Snowflake rather than, like their own AWS product. And I thought that
Yeah.
was really interesting that,
Wow.
like, that's how powerful it is. Like Amazon had actually gives higher commissions for Snowflake because so many customers wanted that. Um,
Interesting.
but yeah, I think that whole space is super interesting. Thanks for breaking it down for us. Just the difference between Databricks and Snowflake. I mean, I've held you almost an hour already. We could keep going, but is there anything else that you'd like to touch on, or any other companies that you're finding interesting lately?
Um, yes, I mean, I think we are so happy that we are investors in 2022, right? I think as an investor, you just have to also adapt a little bit to the times in which you're living. And I think being an investor in the 80s and the 90s was very interesting, but very different to think about companies then as opposed to now. And at one hand, I think, value is always determined by discounted future cash flows, and that's like a physics law, right? But how you recognize that value that is going to produce those earning streams has become maybe more of an intellectual challenge compared to just measuring things in the P&L, which maybe is giving is making our jobs as active investors more interesting. I think what makes our job difficult is that if you look at Amazon, the valuation was probably never as cheap as it seems today, right? Maybe it's a sign of that it's more maturing as a business, which also can be a good thing because you buy still a very good compounder at a much lower valuation that's actually last year produced a free cash flow. But let's say that's your competition, right? So let's say Amazon would be a 2x in 6 years. And if that's my personal opportunity of cost of capital, it means that we as investors, we should try to outperform that. So the difficulty and the challenge in the next 6 years or decade is going to be, okay, can we have this portfolio of amazing companies that are just a little bit younger generation than maybe Amazon or Alphabet, but are just as high quality companies and that have the potential to with to 4x or 10x in the next decade versus double or so. So it's our job is really interesting, and I'm so excited, especially now not after the sell-off, because we talked to so many investors over summer, and they, many families, especially in Europe, they had a lot of exposure to real estate or industrial companies or art, etc., but very underweight the digital space, and it was very hard for them also because of valuations. And now, if the market becomes a little bit more quiet and less volatile, I think that huge fear of valuations is a little bit less than before the sell-off. And then it all comes down to performance, right? And the underlying fundamentals of those businesses. And I feel what people would have described as being growth investments in the summer now have really turned into kind of value investments, clear value investments, where you can really calculate that those companies might have limited downside just because revenues keep growing at a certain percentage and then with very healthy profitability. So yeah, it would be nice to talk again in the future, and then we come back to this and see how we did compared to Amazon.
Yeah, I love that. I mean, that's so true. Big tech is kind of the bogey because they're such amazing companies that if you don't own those, you got to be beating them, or else you might as well just kind of call it a day and buy the big tech
Yes.
companies. Um, well, thank you so much, George, for coming on. And just one last question, closing question we like to ask is, are there any daily habits that have contributed to your success?
I love nature, and I love going for a run in the morning or a swim in summer outside. And I think I feel the difference in the afternoon if I swam that morning or not. So I kind of feel very energized, especially if you go into cold water, which you can train. So being outside, it helps a lot. And I spent actually most of the weeks after Lehman went bankrupt in 2008 in the mountains, and we were buying quite a lot of companies back then. And I think being outside helps, being away from the daily noise. And also in the last few weeks, like in January, when every day the tech market came down so much, I was in the mountains, and it just helps to have perspective and to read. And so for me personally, I think that's one of the things that helps me very much, just being outside.
I
And the
love that
great thing,
answer.
actually, the great thing is that, and I really am so happy with it, that now we have podcasts, right? You can go for a walk and you can listen to these super interesting like insights that founders speaking about their companies. And it also, I feel having podcast is a game changer. I love reading, but to be honest, I spend less time reading books now, and I think the number one reason is actually because I can listen to podcasts. And especially sometimes when people ask me, well, how do you judge the culture of management, right? Okay, that's a super hard question. How do you judge? Because it's not one thing, it's this whole combination and intuition and gut feeling. But listening to founders talk about their company gives me so much more insights, I think, in how they see things and what kind of person they are, compared to like reading a transcript, right? Which is more like a machine that I could be reading about a machine. But hearing like their intonation or how they talk about other people, I think that's a very important component of judging culture. And it's podcasts and being outside that works really well.
I love that. Well, thank you so much, George, for your time. I've really appreciated this conversation, and yeah, just thanks for coming on.
Thank you for your time. Ciao.